It is 5:48 a.m. on the East Coast. We're seeing futures scrubbing yesterday's losses. The Nikkei sees a massive late session surge. And, well, all eyes are on the 8.30 jobless claims to see if the cooling trend is actually hitting the heat.
Right, and we are tracking a massive overnight move in Lumina Quantum Systems after that breakthrough 4,000 qubit announcement. The hardware war is back. I mean, we're digging into the pre-market volume right now, and it is wild.
Yeah, it really is. Good morning, everyone. From the floor of the exchange to the screens on your desk, this is the Bulls, Bears, and the Bell podcast. We are bringing you the exact edge you need before the opening cross. Today's Thursday, August 13th, 2026, and we've got a heavy deep dive for you.
Oh, yeah, we do. Yesterday, the market just let out this massive sigh of relief. A surprisingly benign consumer price index report flashed across the terminals, and equities just instantly caught a bid.
They really did. But looking at the underlying pre-market data today, it feels like the markets might be celebrating while the ship is still quietly taking on water. We're staring down a stack of institutional flow data and macro sheets to figure out if we can actually start breathing normally again, or if that CPI print was just a localized delusion.
Yeah, exactly. Because the contrast between yesterday's consumer-facing data and today's pre-market wholesale data is honestly pretty jarring. We aren't looking at what consumers are paying at the register today. We are looking at the foundational costs of the global supply chain.
Right.
So whether you're, managing a massive institutional portfolio or just trying to model out forward earnings, today's data reveals the actual mechanical gears driving the 2026 economy. And those gears, they are grinding heavily.
Let's start with the big map, the overnight action. Tokyo just wrapped up, and the Nikkei 225 is up 1.67%, settling at 68,218. It seems like the Bank of Japan's latest wait-and-see stance on rates is giving the tech sector some much-needed breathing room.
It's a total ripple effect. Like, look at the DAX in Frankfurt right now, up 60 basis points. But the real story is London. The FTSE is lagging hard because of those weak North Sea energy exports.
Right. And if you're looking at U.S. futures, the S&P 500 is currently pointing to a green open, but it's flat. I mean, hovering right near 7,445, up a microscopic 0.09%. The NASDAQ 100 is leading the charge slightly, up 0.03%.
The market is completely paralyzed, just, frozen, waiting for 8:30 a.m. Eastern time. We've got two massive data drops hitting simultaneously, initial jobless claims and the producer price index.
Yeah, let's get into that inflation puzzle. Analysts are looking for jobless claims to remain stable around that 199K mark, right?
Exactly, which basically shows the labor market hasn't cracked, but the heavy hitter is the PPI. Markets are bracing for headline wholesale prices to come in at 7.2% year over year and 0.4% month over month.
But is it still incredibly hot?
It is. But if we see a definitive cool down, the futures market will immediately price in a 65% probability that the Federal Reserve holds interest rates steady in September. That's the threshold for cementing this famous soft landing narrative.
Okay, but I have to push back on that soft landing terminology because it's starting to mask the reality of the pricing environment for these companies.
Oh, 100%.
Right. Let's assume jobless claims hold at 199K and wholesale prices do print at 7.2% year over year. A 7.2% wholesale increase stacked on top of the massive compounded increases we've seen since 2021 is just brutal for corporate margins.
It's a massive squeeze.
Exactly. If unemployment stays low, labor costs remain elevated. If PPI is up 7.2%, input costs are elevated. A soft landing in this context just means we didn't crash the plane, but, we landed on a plateau that is permanently thousands of feet higher than where we took off.
Yeah, consumers and corporations are still dealing with the altitude sickness of those higher absolute costs. If a manufacturer's inputs are up 7.2% and they can't pass that entire cost onto a consumer who is, by the way, already totally tapped out, that manufacturer absorbs the hit.
Right.
The rate of inflation might not be accelerating like it was a year ago, but the sheer compounding effect of these elevated base levels is actively destroying purchasing power. And to understand why that 7.2% PPI number refuses to normalize, you really have to look past monetary policy. Interest rates don't dictate the cost of raw physical inputs.
No, they don't, which pulls us right into the energy and agricultural markets. Looking at the energy sector this morning, West Texas Intermediate crude is trapped in this suffocatingly tight channel between $83 and $88 a barrel.
It's oscillating violently.
It really is within that $5 range.
Yeah.
Because we have two massive, totally opposing macroeconomic forces colliding in real time.
Right. So on the deflationary side, OPEC just officially revised its world oil demand growth forecast for 2026 downward. They are projecting softer physical consumption, which acts as a heavy anchor on the forward pricing curve.
But on the inflationary side, we still have the ongoing geopolitical stalemate in the Strait of Hormuz, acting as this massive counterbalance. Algorithmic trading models are just constantly pricing in the tail risk of a supply disruption.
Yeah, because a physical disruption there removes millions of barrels of petroleum liquids from the market overnight. So the market is caught between OPEC saying, demand is weakening, and the geopolitical reality saying supply could vanish.
And energy is just one pillar of those raw inputs. We also have to monitor the WASDE Day report, the World Agricultural Supply and Demand Estimates, which is dropping at 4:00 p.m. Eastern today.
That is going to be crucial. Agricultural yields feed directly into the core inflation models. If crop yields come in higher than expected today, we could finally see the forward estimates for feed costs drop, which eventually, brings down livestock and grocery shelf prices.
Let's hope. But physical constraints aren't just limited to commodities. At 4:30 p.m. today, Next NRG, ticker NXXT, is hosting its Q2 conference call. Institutional money is going to be dissecting every word of that call for ground-level insights into energy infrastructure constraints.
Oh, absolutely. They want to know if the physical grid can actually support current industrial capacity, especially with all these new data centers coming online.
Which brings up the central paradox of this current market. We have OPEC actively lowering their 2026 demand forecast. The physical economy, manufacturing, shipping, traditional commodity consumption is clearly showing signs of macro fatigue.
Yeah, it's slowing down.
But the broader global equity indices are completely ignoring this physical gravity. They are decoupling entirely from traditional economic indicators.
Capital is just fleeing the physical economy and seeking refuge in digital infrastructure. Look at the overnight Asia-Pacific session we just talked about. South Korea's KOSPI index ripped higher by 3.78%.
An index-level move approaching 4% in a single overnight session is historic volatility.
It really is. And the SDOXX 600 in Europe is seeing the same momentum, up 0.11%, led entirely by the tech sector. It's all being driven by AI capex.
Right. Capital expenditure for artificial intelligence infrastructure is operating a completely different universe than the rest of the economy. We saw some sector rotation and pullbacks in late July, but the pre-market research notes from Jefferies today confirm that institutional spending on AI infrastructure hasn't flinched at all.
No, zero signs of slowing down. U.S. peers are issuing upbeat guidance, and it's triggering this global frenzy for anyone manufacturing the underlying hardware. The hyperscalers, the massive cloud providers, are in an existential arms race right now.
They just can't afford to underinvest, regardless of what interest rates or oil prices are doing.
Exactly. If you miss this capex cycle, you lose enterprise cloud dominance for the next decade. That's why Applied Materials, ticker AMAT, is seeing massive pre-market volume this morning ahead of their tech updates. Analysts are projecting earnings of $3.40 per share on $8.99 billion in revenue.
And then there's SanDisk, ticker SNDK, which is heavily volatile right now, leading into their 2026 Investor Day at 9:00 a.m. Eastern. The entire semiconductor space is aggressively bidding for updates on their new QLC 3D flash technology.
Yeah, let's get into the actual mechanics of why QLC 3D Flash is commanding so much capital right now. When you are training or running inference on a massive large language model, your limiting factor isn't just compute power anymore.
The bottleneck has moved to memory bandwidth and storage speed.
Precisely. You have these hyper-advanced GPUs sitting idle for microseconds just waiting for data to be retrieved. QLC, or quad-level cell flash, drastically increases data density by storing 4 bits of data per memory cell.
So when you optimize that architecture specifically for the sequential read-heavy workloads of AI data centers, you suddenly unbottleneck the GPUs.
Exactly. The capital flowing into SanDisk and Applied Materials isn't speculative software money, it's hard infrastructure spending.
We're watching the equivalent of the 19th century railroad boom. I mean, everyday consumers aren't buying AI at a scale that moves the needle yet. The killer app for the average person is still nascent.
Right, they aren't buying the train tickets yet.
Exactly. The real structural wealth is flowing exclusively to the foundries, the chip designers, and the storage architects laying down the steel tracks. If you are manufacturing the silicon picks and shovels, you are absorbing all the market's liquidity.
And look, we also have to talk about Lumina Quantum Systems.
Oh yeah, the quantum surge.
Right. Ticker everyone is watching this morning. We're seeing a 14% spike in pre-market trading for them. They've cracked the error correction code 3 years ahead of their own 2029 roadmap with this new 4,000 qubit announcement.
Which isn't just a hardware win, it's a direct threat to every encryption standard on the planet. I'm hearing from analysts that this could trigger a sector-wide re-rating for cybersecurity firms today.
Yeah, which means we have to closely watch the cyber ETF, ticker C-SEC, today. If Lumina is the spear, these cybersecurity firms are scrambling to build the shield.
It's fascinating. But, that massive capital concentration into digital tech creates aggressive distortions elsewhere, especially when we look at the macroeconomic foundation underneath foreign exchanges. Japan's equity market is hitting 68,218 on the back of this semiconductor boom. But simultaneously, the Japanese economy is buckling under a massive currency crisis.
It really is, and it's threatening to spill over into the global forex markets today. The USD to JPY pair is trading dangerously close to the 160.0 level.
The yen is deteriorating fast. And while the weak yen traditionally benefits a tech-heavy export economy by making their goods cheaper abroad, Japan imports over 90% of its energy.
Right, so when your currency collapses against the dollar, importing oil and food becomes devastatingly expensive. It basically just imports inflation directly into the domestic economy.
And we are seeing that imported inflation manifest in real time. Over in New Zealand, the RBNZ just reported steady 2-year inflation expectations, showing regional stability. But Japan's July PPI unexpectedly jumped to 2.2%.
Which is massive for them. For an economy that spent decades structurally paralyzed by deflation, a 2.2% wholesale inflation spike is a blaring alarm bell. It puts the Bank of Japan in an incredibly hostile position heading into September.
They are being forced to consider hiking interest rates just to defend the currency.
Yeah. And the Ministry of Finance might not even wait for a September rate hike. Finance Minister Satsuki Katayama stated explicitly this morning that the Bank of Japan and the U.S. Treasury won't hesitate to intervene.
They are actively threatening to step into the open market, deploy their foreign dollar reserves, and aggressively buy yen to force the price up.
And a joint intervention of that scale introduces severe intraday tail risk for anyone trading global macro today. If the BOJ and the U.S. Treasury step in, we will see violent algorithmic repricing across every major currency pair.
Absolutely. The forex markets could be trading in a completely low volatility environment at 10:00 a.m., and by 10:01 a.m. the entire market architecture is convulsing as liquidity gets vacuumed up by central banks.
But, let's look at the actual mechanics of an intervention. If the U.S. and Japan deploy billions to artificially bid up the yen today, they're essentially treating the symptom while ignoring the disease.
It's like a struggling company using its finite cash reserves to execute a stock buyback just to prop up the share price, while the core business continues to bleed.
Exactly. And the core business here is the interest rate differential. Capital flows toward yield. As long as U.S. Treasuries offer a significantly higher risk-free yield than Japanese government bonds, the macro flow of capital will relentlessly short the yen.
Right. Intervening without fundamentally changing the underlying interest rate policy just invites hedge funds to fade the intervention the moment the central banks step away.
It buys time, sure, but it fundamentally burns through foreign reserves to fight financial gravity. The Bank of Japan is trapped in a total doom loop. If they hike interest rates aggressively to save the yen and close that yield spread, they risk triggering a domestic debt crisis because their sovereign debt load is so massive. The cost to service that debt would just skyrocket. But if they do nothing, the currency continues to collapse and imported inflation crushes the Japanese consumer.
Speaking of the consumer, we do have some pretty compelling counter data coming out of the pre-market section regarding China. JD.com, ticker JD8AD, and NetEase, ticker NTES, are both trading up after beating their respective revenue estimates.
And JD.com is the primary barometer we use for the health of the Chinese consumer class.
Exactly. This creates an incredibly complex dynamic for global demand. We have OPEC forecasting a slowdown in physical demand, the U.S. trying to stabilize a high-altitude inflation plateau, and Japan fighting a currency collapse.
But if JD.com's earnings suggest the Chinese middle class is finally moving past their domestic real estate slump and accelerating consumption, well, that introduces a massive new demand shock into the system.
Right, because if Chinese consumption accelerates, it bids up the price of global commodities, which then makes Japan's imported inflation crisis even worse.
It's crazy. Today is a perfect example of how interconnected the global machine is. Every single one of these data points is pulling on the exact same thread.
Yep. The 8:30 a.m. U.S. PPI print dictates the forward curve for Fed funds rates. That Fed policy dictates the strength of the U.S. dollar. The dollar's dominance relentlessly crushes the Japanese yen, backing their central bank into a corner where they have to threaten open market intervention.
And while all of this traditional macro warfare plays out in the physical economy and the currency markets, the global AI infrastructure build-out just completely ignores the chaos, relentlessly pulling capital into semiconductor foundries and data centers.
It requires institutional capital to operate with a split personality. You have to actively hedge against a traditional physical slowdown and potential currency volatility, while simultaneously remaining heavily long on a digital infrastructure cycle that refuses to recognize any macroeconomic headwinds.
That split personality is perfectly encapsulated by one final data point buried at the bottom of today's sheet. Apple, ticker AAPL, is trading completely flat this morning.
Yeah, even though today happens to be the day their 27-cent quarterly dividend is payable.
Right. And for the better part of the last 15 years, Apple was the undeniable center of gravity for the market. The consumer device was the ultimate economic driver. But look at where the volume and the volatility are concentrated this morning.
It isn't in consumer tech. The market's entire focus is totally consumed by Applied Materials, SanDisk, Lumina Quantum, and the companies architecting the invisible data centers powering large language models.
The Chinese consumer might be waking up according to JD.com, but they aren't necessarily driving the global market narrative the way they used to.
So as we watch this 2026 market unfold today, I'll leave you with this provocative thought. Consider whether the era of dominant consumer devices is quietly sunsetting. Are we reverting to an industrial dynamic where the companies pouring the concrete, laying the fiber optics, and building the physical plumbing of the internet hold the actual structural power?
Leaving the consumer-facing brands to fight over increasingly thinner margins, it's a profound shift in market leadership. The capital flows we are tracking today indicate that the market has already made its decision on where the next decade of value is going to be generated.
It really does. The market held its breath yesterday and got the CPI print it wanted. Now the 8:30 a.m. data hits, and we see how the architecture handles the exhale. Thank you for listening to this deep dive on the Bulls, Bears, and the Bell podcast.
Keep questioning the underlying mechanics, stay skeptical of the headlines, and don't forget to subscribe to the Bulls, Bears, and the Bell podcast on Spotify or your favorite podcast app.
We will catch you next time before the bell rings.